It's been less than a week since the S&P 500 hit a new all-time closing high. Last time that happened, October 2007. In fact, according to some market watchers, at the end of March, the S&P 500 price was 56% above its long-term trend. So what determines how markets move? David Gurwitz is managing director at forecasting firm Charles Nenner Research. Great to have you here.
Thank you, Amanda.
Market cycles is basically how you sort of predicate where you're going to go. So let's talk about the cycles and how predictable they are.
Right.
What can we tell?
Let me give you two examples that are easy to visually see when people are watching. Let's take bonds and bond rates, okay? They're very low now. Interest rates are very low. 30 years ago, they were very high. 60 years ago, there was an invention called television, and the first advertiser then was the U.S. government selling 2.5% savings bonds. Rates were very low. That's a 60-year cycle. So according to us, and that goes back hundreds of years, by the way, 1920 rates were high, 1890 rates were low, 1860 rates were high. So therefore, according to that, 2040 rates are going to be high again. Bond prices, which go the opposite way, are going to be low. That's the way everything works according to us, if you find a data series long enough. So therefore, we've predicted bond prices to go up in the past, which they have. They should stay strong until June, the TLT. And then afterwards, people should be looking for TBT to short bonds for a long time. Everything works like that. Stocks, bonds, commodities, currencies, any data series.
You know, I'm short, I own TBTs right now, which is basically short bonds.
Right.
It has been a very unrewarding, unenjoyable process because I've learned in the cycles of investing that you can't predict when it turns.
So we don't agree with that. We think you can predict timing based on the repetition.
So give me a month that I should actually increase my TBT position.
Well, you should have, well, too bad you weren't watching us a few years ago, but towards the end of the summer, you'll see rates will begin to go up for the next 25, 26 years, and that's the time your TBT should go up in value for quite a long time, minus the every year the value will go down because it's an ETF, but nonetheless should be a very good investment.
What makes cycles so predictable? Because events change so dramatically. The fundamentals change so dramatically. Why would we think that the equity markets today would perform anything like in the 1920s?
Well, because our feeling is everything repeats in patterns. Humans don't have the free choice they say they do. I'll give you two other examples, both relevant to Canada. One is nat gas. When we called nat gas to go from $6 to $1.70 about 2 years ago, everyone thought we were crazy. As it approached $3, many of the Canadian banks, which are our clients, they had made loans to the Canadian companies in the nat gas field when it was $5, and they were getting pressure, so they forced them to sell, which further reduced the price. What came first? Was it the cycles heading down, or was it the bank acting? We think the cycles determine what's going to happen, and therefore, then what happens? When we called Apple the top at 700, and the target was 500, 80% of analysts stayed long. They call that fundamental. We think cycles are much more fundamental than so-called fundamentals, and it works with everything.
So if you can call these trades, do you find your clients are willing to actually put a leveraged amount of dollars behind it? In other words, double and triple their bets? And have they been rewarded?
That's a great question, because that goes to the psychological nature of trading. We don't trade. We just sell research, because we have family offices, sovereign wealth funds, institutions. Everybody's different. You, given your background, would probably take a stronger bet because you can live more with the different dislocations given how you've been a businessman. A certain person, certain institution can't live with those ups and downs, so they'll wait until a cycle top and then go a little bit in. We tell people all the time, just because it's heading down, like nat gas should retest its low in a year. Should you go put a put on now? No, because you have to live through it. Like you're living through pain now with the TBT trade.
You're right about
we
that.
would have kept you out of that. And that's kind of what we like to do.
One of the others I want to hit, because I know a lot of people who are investors care deeply about it, is gold. You actually have an interesting take on the cycle for gold.
We took everyone out at 1900. And we've been telling everybody wait and wait and wait. Especially, we have clients all over the world, so Canadians obviously love gold. They haven't loved gold the last year and a half. We said it was going to 1539 as of last week. We don't only give direction, we give the level as well. It got to 1539, it bounced. It should be bottoming at the end of this month. Gold stocks as well, but we think gold will do better than the gold stocks.
And you've got a target on the upside.
We have a 2,200 target off. It's not going to jump up so fast, but don't think it's just, but just the fact people have been in gold, I don't think they should get out now.
Right, stay in.
Yeah.
All right. David, great to have you with us.
Thank you.
David Gurwitz, Managing Director of Charles Nenner Research. Coming up, a look at how big retailers are benefiting from an eco-friendly approach more than the environment is. We'll talk to the author of Eco Business next.